I'm joined now by my colleague Jake Barnett to provide our Sustainable Investment Stewardship update. We've been seeing a lot more news about ESG in the headlines recently, with prominent anti-ESG critics and skeptics coming to the forefront. So Jake, I'd like you to focus your update this quarter on that subject. Can you tell us a little bit more about why these criticisms are happening?
Sure, Joe. Happy to speak on this. As you said, lately there has been a rise in criticism and skepticism about ESG, or environmental, social, and governance investing. ESG has been around for many years now, first gaining prominence in 2005 with the formation of the Principles of Responsible Investment, of which Wespath was a founding signatory. However, the growth in interest and investment flows into ESG strategies has sharply increased, especially over the last 5 years. This has been driven by a number of factors, including increasing investor recognition of the financial risks associated with environmental and social issues. Those issues include topics like climate change and diversity, equity, and inclusion. And that focus is paired with an increasing recognition that you do not necessarily have to give up investment performance to invest in ESG funds. I think a lot of the pushback on ESG is actually a signal of it becoming a victim of its own success. As this trend gained prominence, there's sometimes been grandiose promises made by ESG practitioners about the ability of ESG to solve a wide range of complex problems. These claims are now increasingly being questioned. Additionally, ESG has become somewhat of a political hockey puck, this year especially, with both sides of the aisle finding reasons to either criticize or laud the investment practice. All of this has led to much more robust dialogue in the public squares about the merits and pitfalls of ESG, more so than anything we've experienced before.
So Jake, what are some of the key criticisms from detractors, and how would Wespath respond to these criticisms?
So, Joe, there's a whole wide range of criticisms depending on the perspective and motivation of the individual making the criticism. But there are 4 key narratives we see from those questioning ESG, and we'll show those on the following slide. The first 2 are long-standing criticisms that have been around since ESG was first introduced into the investment ecosystem. So the first one you see is that consideration of anything other than financial factors will lead to lower returns. The second is that ESG is nothing more than a marketing exercise and way for asset managers and consultants to charge more fees. The third criticism that has emerged more prominently in recent dialogue effectively follows a line that this is an overtly liberal and partisan exploitation of the tools of finance by investors to further political goals. The last criticism often comes from individuals who may believe in the goals purported by ESG, but do not think that investment is the proper means to achieve those goals. On this next slide, you see our perspective and responses to some of those criticisms. The first 2 are relatively straightforward. As a long-term investor who has over a decade of experience using ESG as part of our investment process, we look at the use of ESG holistically and as part of a good, robust investment process. As such, it has not been our experience that it leads to lower investment returns. Secondly, as an institutional investor, we recognize that some fund managers may try to charge higher fees for ESG strategies, but we categorically do not pay more simply for ESG integration. We think this should be integrated as part of an asset manager's approach and not an add-on that they charge more for. On the third point, it is important to note that we analyze investment and engagement decisions through the lens of our sustainable economy framework. As a quick reminder, this framework states that investors need to support the transition to a sustainable global economy in order to achieve the returns that support their financial goals. We recognize that such a transition is a complex proposition, and no one corner of society has all the answers of what that should look like. As such, we try to be holistic, curious, and open-minded in taking in any information that will support us better understanding the risks, regardless of the source. Finally, on the last point, we engage in deep due diligence with our asset managers, including an annual questionnaire and focused engagement follow-ups that help us understand the underlying actions that managers are taking beyond their high-level stated activity. This helps us understand the core investment process of the managers and their alignment with our sustainable economy framework.
It's all great information, Jake. How can people continue to learn what we're doing on this topic?
Our CIO, Dave Zellner, wrote an excellent op-ed on this topic that you can find on our website. I would encourage everyone to start there in terms of their reading. Additionally, we will continue to publish blog posts and other social media talking through our perspective. So if you're not following us on social media already, please do so.
Great, Jake, thanks for your time and for that wonderful update.
Thanks, Joe.